Welcome, all finance enthusiasts. The SIE, or Securities Industry Essential Exam, is an excellent way to begin your career in the financial investments sector. It encompasses the fundamentals of the industry and prepares you for more advanced examinations. Now let us continue preparing you to pass the Securities Industry Essentials exam. Now that both GEO and revenue bond issues have been examined, let's consider shorter-term municipal instruments, municipal notes. Municipal notes are short-term instruments typically issued to finance a project or assist a municipality in managing its cash flow. Municipal notes are interest-bearing securities that ultimately pay interest at maturity. Tax anticipation notes, or TANs. TANs are issued to finance current municipal operations in anticipation of future tax receipts from property taxes. Additionally, TANs are generally classified as general obligation securities. Revenue anticipation notes, or RANs. RANs are issued for the same purpose as TANs, except that they are issued in anticipation of receiving revenues at a future date. Tax and revenue anticipation notes, or TRANs. TRANs are created when TANs and RANs are issued together. Bond anticipation notes, or BANs. BANs are issued to obtain financing for projects that will eventually be funded through the sale of long-term bonds. Grant anticipation notes, or GANs. GANs are issued in expectation of receiving funds or grants from the federal government. Construction loan notes, or CLNs. CLNs are issued by municipalities to provide funding for the construction of a project that will ultimately be financed by a bond issue. Ratings for municipal notes. As explained in our previous segment, Moody's and Standard & Poor's issue ratings for fixed income securities. Both organizations also maintain a rating system specific to municipal notes. Moody's has 4 rating categories for municipal notes and variable rate demand obligations, which are described below. The first 3 ratings are considered Moody's investment grade ratings, with the 4th being a speculative grade. Variable rate demand obligations receive ratings based on a variation of the MIG scale, the Variable Municipal Investment Grade System. MIG-1 or VMIG-1 represents superior credit quality. MIG-2 or VMIG-2 indicates strong credit quality. MIG-3 or VMIG-3 signifies acceptable credit quality. Finally, SG stands for speculative grade credit quality. Standard & Poor's has the following 4 rating categories for municipal notes. SP1+, which signifies a very strong capacity to pay principal and interest. SP1, indicating a strong capacity to pay principal and interest. SP2, representing a satisfactory capacity to pay principal and interest. And SP3, which denotes a speculative capacity to pay principal and interest. Other municipal securities, auction rate securities. Auction rate securities, or ARSs, are long-term investments that have a short-term twist. The interest rates or dividends they pay are reset at frequent intervals through auctions. Investors who purchase ARSs typically seek a cash-like investment that pays a higher yield than what's available from money market mutual funds or certificates of deposit. Generally, there are 2 types of ARSs: bonds with long-term maturities of 20 to 30 years, and preferred shares with a cash dividend. Both the interest rate on the bonds and the dividend on the preferred shares will vary based on rates set through Dutch auctions for specific short periods, usually measured in days, 7, 14, 28, or 35. Auction rate bonds are issued by entities such as corporations, municipalities, student loan authorities, and museums, while auction rate preferred shares are issued by closed-end funds, which will be examined later in the series. Variable rate demand obligations, or VRDOs. Another long-term security marketed as a short-term investment is a variable rate demand obligation, or VRDO. A VRDO's interest rate is adjusted at specified intervals, daily, weekly, or monthly, and in many cases, this adjustment allows the owner to sell or put the security back to the issuer or a third party on the date a new rate is established. If this occurs, the investor receives the par value plus accrued interest. Investors interested in short-term investments may also purchase other tax-free money market instruments such as tax-exempt commercial paper and tax-free money market funds. Tax-exempt commercial paper has a maximum maturity of 270 days and is typically backed by a bank line of credit. The primary market for municipal bonds. Like U.S. government and government agency securities, municipal securities are exempt from the registration and prospectus requirements of the Securities Act of 1933. Although exempt, the underwriting process for municipal securities follows many of the same guidelines used for corporate underwritings. The Municipal Securities Rulemaking Board, or MSRB, is the self-regulatory organization for firms that deal in municipal securities. It formulates the rules and regulations related to municipal underwritings. Issuing GO bonds. Since GO bond issues are backed by taxes, the following two requirements must be satisfied. First, voter approval. The issuance of general obligation bonds usually requires voter approval since the funds generated by taxing citizens are used to pay the debt service. For a general obligation bond, the indenture, which is a written contract, typically includes the statutes that permit the issuer to levy taxes. Second, debt ceiling limitations. A GO issue is generally subject to debt limitations imposed on the municipality by a voter referendum or by statutes. Issuing revenue bonds. Since revenue bonds are backed by user fees generated by a project or facility and not by taxes, voter approval is not required. However, there are special procedures to follow and requirements to meet before issuing revenue bonds, one of which is conducting a feasibility study. A municipality must hire a consulting engineer to study the project and present a report assessing whether it can generate the necessary revenues. This report examines the need for the proposed project and evaluates whether it represents a sound economic investment. An accounting firm is usually retained to help determine if the revenues will be sufficient to cover expenses and debt service. New issue underwritings. Once a municipal issuer determines that there's a need for a bond issue and has followed the preliminary steps needed to offer a bond, such as obtaining voter approval for a GO issue or completing a feasibility study for a revenue issue, it may proceed with the issuance process. At this point, the municipality typically seeks the assistance of an underwriter or investment banker. A municipal underwriter plays an important role in the process of offering securities. The underwriter acts as a vital link between the issuer and the investing public by assisting the issuer in pricing the securities, structuring the financing, and preparing a disclosure document, which is referred to as the official statement. In some cases, the issuer will simply appoint its underwriter through a process referred to as a negotiated sale. Another method involves inviting interested underwriters to submit proposals through a bidding process known as a competitive sale. With a negotiated sale, an issuer brings its issue to market by selecting the lead underwriter or senior manager who will sell the issue to the public. Essentially, the issuer requests the assistance of the firm it wants to work with. The size of the issue, the coupon rate, possible call provisions, and other details are generally decided during negotiations with the underwriter. Rather than selecting its underwriter directly, an issuer may invite interested underwriters to compete against one another by submitting bids for the issue. The syndicate that submits the best bid is awarded the bonds. Typically, the best bid is the one that offers the issuer the lowest interest cost over the life of the issue. The following summarizes the primary methods that different issuers use for underwriting purposes: U.S. government securities, auction process, municipal general obligation bonds, competitive sale, municipal revenue bonds, negotiated sale, and corporate bonds, negotiated sale. Forming a municipal syndicate. Traditionally, several broker-dealers combine to form an underwriting syndicate, and one firm acts as the syndicate manager or lead underwriter. The syndicate is essentially a group of underwriters that share the liability and risk for selling the issue. Although the syndicate's composition may change, it usually comprises firms that have worked together in the past. Municipal issues are typically sold on a firm commitment basis, which means that the selected or winning syndicate is fully responsible for selling the entire offering. Corporate bonds. Corporations that issue bonds use the proceeds from the offering for various purposes, from building facilities and purchasing equipment to expanding their businesses. The advantage of issuing bonds over issuing stock is that the corporation does not give up any control of the company or any portion of its profits. However, the disadvantage is that the corporation is required to repay the borrowed money plus interest. If a corporation has common and preferred stock outstanding and issues bonds, it must pay the interest on its outstanding bonds before paying dividends to its stockholders. Additionally, if the company goes bankrupt, bondholders and other creditors must be satisfied before the stockholders can claim any of the company's remaining assets. Although buying corporate bonds puts an investor's capital at less risk than purchasing stock of the same company, bonds typically do not offer the same potential for capital appreciation as common stocks. Types of corporate bonds. Corporate bonds are divided into two major categories: secured and unsecured. Although all debt issued by a corporation is backed by the issuer's full faith and credit, secured bonds are additionally backed by specific corporate assets. The money market. Debt securities with maturities of more than 1 year are often referred to as funded debt, while short-term debt instruments with 1 year or less to maturity are known as money market securities. A significant number of securities trade in the money market, with issuers including the United States government, government agencies, banks, and corporations. There is also a diverse group of participants utilizing the money market, such as the Federal Reserve Board, banks, securities dealers, and corporations. Money market transactions provide a means for both acquiring money or borrowing and investing or lending excess funds for short periods. Typically, the investment period ranges from overnight to a few months but may extend to 1 year. Alright, let's dive into the types of money market securities. Examples of money market securities and related instruments include commercial paper, bankers' acceptances, negotiable certificates of deposit, federal funds, money market mutual funds, and repurchase agreements, often referred to as repos. Money market instruments are a distinct asset class and are referred to as cash equivalents. Since cash equivalents are investments of high quality and safety, they are considered nearly the same as cash. Something to keep in mind. In most states, taxpayers do not pay state and local taxes on bonds issued by municipal entities located in the states where they reside. In our next video, we will examine the various measurements of return for both equity and debt investors. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but a huge support for us, and it is entirely free. Please turn on your notifications to be among the first to be introduced to our next segment and excel in the SIE exam.